Hi everybody, it's Professor Olney. I'm going to do a video for you on how to model the effect of an excise tax in a market. I know that that's a complicated thing. I get a lot of questions in office hours about it, and I hope that this video helps you a little bit in terms of seeing how to draw it so you can replicate it yourself. So it's the first time I've done this. Stick with me. Here we go. So I have a little whiteboard here. Isn't that cool? And we're looking at the effect of a sales tax on a market. So let's draw ourselves some axes. And as always, we're going to put price on the vertical axis and quantity on the horizontal axis. And let's start with a downward sloping demand curve. I'm going to label it D1. An upward sloping supply curve. I'm going to label it S1. And I'm going to find the equilibrium, price P1, and quantity Q1. So price P1 is the original price, and that's the price that was before the tax. It was paid by the buyer, and it was received by the seller and retained by the seller. So we're starting with a no tax situation. Then what we're going to do is we're going to implement a tax, and we're going to do a constant dollar tax. So we're going to have a tax of size T. For instance, we might have a $2 tax, where every item that's sold has to pay, there has to be a $2 tax that's going to be paid to the government. We have a choice to make at this point. The choice is, who is it that's sending the tax money off to the government? If the seller is sending the tax money off to the government, then the tax is really affecting the cost to the seller. And so we're going to show the effect of the tax by shifting the supply curve. If the buyer is sending the tax money to the government, then the tax is affecting the behavior of the buyer because it's increasing the cost directly to the buyer. And so we're going to show that as a shift of the demand curve. So we have to choose, is the tax being remitted or sent to the government by the buyer, shift the demand curve, or by the seller, shift the supply curve? It's very, very difficult to think of an example in which the buyer is remitting the tax, and so we're going to go with the norm, which is to show the tax as having the effect on the seller, because the seller typically is the person who writes the check and sends the money to the government once the tax money is collected. The seller, the sellers, because this is a market, the sellers ideally would like to pass that entire tax on to the buyers. And so what the sellers would like to do is they would like to see the price that they charge for whatever quantity they're selling increase by the full amount of the tax. And so for each and every quantity supplied that we read along the horizontal axis, the price at which the sellers would sell that quantity is going to be the original price, whatever it was along that black line, the supply 1 line, plus the tax. So supply 2 is supply 1 increased by the amount of the tax. Those are parallel shifts. My drawing's a little bumpy, but just pretend those are parallel lines. If we had a percent tax, a 10% tax, for instance, instead of a $2 tax, then the second supply curve wouldn't be parallel to the first supply curve, because at a low price, the tax is a small dollar amount. At a high price, the tax is a large dollar amount. And so in that case, the supply curves would not be parallel. They'd be skedaggling like that. But let's stick with the easy one. So what happens? They want to pass the entire tax on to the buyers, but the demand curve is downward sloping, which means that as the price goes up, there are fewer individuals who want to buy this product. The equilibrium price is going to settle at the intersection of supply 2 and demand 1. So I'm going to dash that over, and that's price P2. Price P2 is what's paid by the buyer. So that's now going to be the price that the buyers pay when they purchase this product. Once the buyers pay that price P2, the sellers have collected that tax, and they have to send the tax dollars, T, off to the government. And so that means that the sellers will retain an amount that's P2 minus T. So that T is going to be sent to the government. And P2 minus T is the amount that's going to be retained by the seller. The way to find P2 minus T on your graph is go over from P2 back until you hit that second supply curve, and then just drop straight down until you hit the first supply curve, because we know the difference between supply 1 and supply 2 is that amount T. So I dropped down, and then I'm going to dash it over, and that's going to give me P2 minus the tax. So that's the first picture, and that's the picture that shows us the effect of the tax. The tax increases the price that's paid by the buyer, but it doesn't increase the price by the full amount of the tax. The only way for the price to increase by the full amount of the tax would be if we had had a perfectly vertical demand curve. So if you look at it and there's a perfectly vertical demand curve, then you can play with it and see that when you shift that supply curve, the price is going to go up by the full amount of the tax, and that's the case, the only case, in which the sellers can pass the tax completely and entirely on to the buyers. So that's what we have as our first step. So there's drawing the tax. The next thing we want to look at is who bears the burden of the tax. The burden of the tax refers to how that tax money, the T, is divided up between the buyers and the sellers. If the buyer paid the entire $2, the buyer would be bearing 100% of the burden of the tax. There'd be no impact on the seller. If the price didn't rise at all, then the buyer would be bearing 0 of the burden of the tax, and 100% of the burden of the tax would be on the seller. So the way that we find the burden of the tax, the buyer's burden is measured by the change in price. So it went up to P2. It was originally P1. So it's the change in the price paid by the buyer. And we're going to express that as a percentage of the tax T. The seller's burden is measured by comparing the amount that the seller retained before the tax with the amount that the seller retains after the tax. And so we're going to take P1, which is what they retained initially, and subtract from that, parentheses, P2 minus T, the amount they retain after the tax, and again express that as a percentage of the tax T. Notice that the buyer's burden and the seller's burden adds up to 100%. So P2 minus P1 plus P1 minus parentheses P2 minus T, that all equals T. So the sum of this is going to be 100%. So let me add some numbers to it so I can give you an example. Let's suppose that the tax T is a $2 tax. Let's suppose that the price P1 was $3. And let's suppose that the price P2 is $4.50. In that case, the P2 minus the tax, that is the amount that's retained by the seller, is that price P2, $4.50, minus the tax $2, or $2.50. So what do we have? The buyer's burden. The buyer finds that the price has gone up to $4.50 from its original price of $3. And we're going to express that as a percentage of the tax, which is $2. So we've got $1.50 in the numerator, 2 in the denominator, or the buyer is bearing 75% of the burden of the tax. The seller, on the other hand, finds that instead of retaining $3, they're now able to retain only $2.50 of each item that they sell. Again, we're going to express that as a percentage of the tax, $2. And so the seller is finding that they have 50 cents less. They're bearing 50 cents of the burden of the tax. Put that as a percentage of $2. And the seller's burden in this case is 25%. So that's how we figure out the burden. The burdens are going to add up to 100%. 75 plus 25 is 100%. The burden is borne by the buyer and by the seller. The next question is, what is it that determines who's bearing the bigger burden? In the example I just gave you, the buyer was bearing 75%. They were bearing the bigger part of the burden. The seller was bearing only 25%. The way to see who bears the larger burden of the tax is to play around a little bit with the slopes. And what I'm going to change is just the slope of the demand curve. You can also do this by changing the slope of the supply curve, and that's perfectly valid. I'm just going to show you a little bit of it so you can play with it later on your own. So I'm going to draw two pictures this time. I'm going to draw them side by side so that we have on one screen the comparison. I'm going to put price on the vertical and quantity on the horizontal on both of these things. And on both I want to draw the same two supply curves. So I'm going to draw supply 1 on the first and then supply 2, which is equal to supply 1 plus the tax. And then I want to try to draw exactly the same supply 1 on the right and supply 2, which is supply 1 plus the tax there on the right. Now what I want to do is add my demand curve. On the left-hand graph, I'm going to draw a relatively flat demand curve. So I'm going to call that demand flat. And on the right-hand one, I'm going to draw a relatively steep demand curve. I'm going to call that demand steep. What happens? So on the left, the original price, which is where the flat demand curve intersects the price, is price P1. And the result of implementing the tax, which remember the distance between these two lines is the tax T. The result of implementing the tax is that the price rises, but not very much. It rises to a price P2. The amount that the sellers retain is the amount P2 minus the tax. So notice that when we have a flat demand curve, the seller is bearing the larger burden of the tax. So the seller bearing the larger burden of the tax when we have a relatively flat demand curve. That's because the relatively flat demand curve is telling us that as the price of the product rises, a whole lot of customers say, I don't want to pay that higher price, I'm not going to buy this product, and they drop out of the market. And so the sellers find they can't really increase the price very much because they start to lose their customers as soon as they start to increase the price. And therefore the sellers have to bear the burden. They have to take a hit in terms of how much they retain from the sale of each item, and the sellers are bearing the larger burden of the tax when the demand curve is relatively flat. Now let's look at the right-hand one. When the demand curve is relatively steep, the original price is P1, where the demand curve intersects the price intersects the supply curve S1. As a result of the tax, which remember is shifting that supply curve by an amount equal to the tax, as a result of the tax, the price rises to P2. I need to find the amount that's retained by the seller, so I start from that price P2 and drop down by the amount of the tax, which is the distance between these two lines, and that gives me P2 minus the tax. Notice that here on the right, when the demand curve is relatively steep, the buyer is bearing the greater burden, the larger burden of the tax, because the price is going up almost by the full amount of the tax. So when you have a steep demand curve, the buyer is bearing the larger burden of the tax. That's the case because when you have a relatively steep demand curve, it means that even as the price rises, most of the customers stay put. So the firms start to increase price, and yeah, they lose a couple of customers here and there, but most of their customers, they probably grumble about paying the higher price, but they go ahead and they pay the higher price anyway. So in a case where demand is not terribly sensitive to changes in the price, we find that in those cases, the buyer bears the larger burden of the tax. A concept that we introduce on Monday, the 18th, puts this flat and steep demand curve in slightly different terms. What you'll see on Monday is that having a relatively flat demand curve, that's consistent with a market in which demand is relatively price elastic. So that's the terminology we'll see on Monday, the 18th of September. That a relatively flat demand curve is consistent with demand being relatively price elastic. Relatively price elastic simply means that the buyers respond a lot. They have a very elastic, big response to a change in the price, which is what we get when we have a flat demand curve. And when the demand is relatively price elastic, the sellers are going to bear the larger burden of the tax. On the other hand, on the right-hand side where we have the relatively steep demand curve, that's when we have demand that is relatively price inelastic. That means that the quantity demanded does not change much in response to a change in price. There's not very much of a change in quantity demanded in response to a change in price. The customers wind up bearing the larger burden of the tax. All right, there's one more thing we need to show, and we need to show the effect of a tax on the consumer surplus and the producer surplus and the total surplus and this thing called deadweight loss. So one more time, I'm going to draw a picture. So here's my axes. It's going to be really fun. I have a lot of colors to choose from, and it's nice to have a lot of colors for this particular graph. Price on the vertical axis, quantity on the horizontal axis. Start with a downward sloping demand curve, label it D1. Start with an upward sloping supply curve, label it S1. Notice that I have my demand and supply curves touching the axis. Because I'm going to be shading in consumer surplus and producer surplus, it's just easier if my curves come all the way to the vertical axis. I'm going to find the equilibrium price P1. This is all before the tax. And then the quantity, of course, is Q1, price P1. And what we know is that the consumer surplus, let's see if I can do some cool colors here. The consumer surplus, ooh, look at that. The consumer surplus before the tax is implemented is the size, is the area of this triangle that is, so we'll call this the original consumer surplus. That looks terrible, doesn't it? Red. So the original consumer surplus is the area that's shaded in sort of a reddish orangey color here, below the demand curve, above the price. And then the original producer surplus is the area below the price and above the demand curve. Sorry, below the price and above the supply curve, my bad. The producer surplus is the area below the price and above the supply curve, the thing I've labeled here in blue. And so that's my original producer surplus, is the area in blue that I've shaded in. And the total surplus, remember, is the sum of the consumer surplus and the producer surplus. It's the surplus that's received by everybody in the society. All right, there we go. That's our setup. Now, we're going to add a tax to this graph. Let me see if I can do, how many colors can I do? So I'm going to add a tax here. So I've got supply curve S2 is equal to S1 plus the tax. And I'm going to need a little space, so let me see if I can erase some of this stuff here. Isn't that cute? That was very cute. Okay, what happens? So the price is going to rise to price P2. So there's price P2. Remember that P2 is the price that's paid by the buyer. And the new consumer surplus is going to be the area of a triangle that I'm going to shade in this brown, and it's the area below that demand curve, which hasn't shifted, and above the new price. So here's my new consumer surplus, is that area that I shaded with the hatch marks, above the price and below the demand curve. The sellers get to retain a price P2 minus T. The sellers, the producer surplus, is the difference between the price they want to receive and the price they actually receive. For the producer surplus, you can compare either the price P2 with the second supply curve, so P2 and the second supply curve, because both of those, P2 and the second supply curve, are taking into account the tax. If I did that, I would have the area of this triangle, which I'm going to do with just a few hatch marks because I need to erase them. I'd have the area of this triangle below the price P2 and above the second supply curve. Alternatively and equivalently, let me see, ooh, this is going to be kind of weird how I'm erasing those brown lines, and that made it really kind of weird, but stick with me here. Alternatively, instead of comparing the second price that has the tax in it and the second supply curve, which has the tax in it, I could equivalently compare the price P2 minus the tax with the supply curve before the tax. And then I'm doing the no tax comparison, because the tax money's been sent off to the government, and the sellers are comparing what they're retaining with their original non-tax costs. And that would be the area of the triangle here that I'm shading with these vertical hatch marks. So it's below price P2 minus T and above the supply curve. Those two triangles that I just shaded, the one that was below P2 and above S2, and the one that's below P2 minus T, the green one, and above S1, those are, ready? Congruent triangles. Those are triangles that have the same area because they have the same base, the same height. 1/2 base times height gives you the area. Those are congruent triangles. So you can draw either one. We draw it this way for a reason that you're going to see in just a second. So the new producer surplus is the triangle that I drew with the vertical hatch marks. All right. What else? The third piece that's a new piece is that there's going to be tax money that's going to be sent off to the government. Right? So there's going to be tax revenue that goes to the government. And the government is the representation of all the people. And so the money that the government receives through this tax is, in a sense, all of ours, both the consumers and the sellers. Sellers are people too. And so we want first to find that tax revenue. Well, the tax revenue is the amount of the tax times the quantity that's sold. Ooh. That is the area of a rectangle that has a base that is the quantity, which I never marked, my bad, quantity Q2. The base that is the quantity Q2, that's the new amount sold, and a height, which is the tax, but the distance between these two supply curves, we know that's equal to the tax. And so the area of this rectangle between P2 and P2 minus T, that's the height, and from the origin to the new quantity Q2, that's the base, the area of that rectangle is the tax revenue. And you think of that as the surplus that's shared by the whole society, which includes both the sellers and the buyers. Cool. What's left? What's left is there's an area here that nobody has captured. This little triangle that I just tried to circle in yellow, I'm going to highlight it in yellow. This little triangle here, nobody gets it. Nobody gets the area of that little triangle that used to be part of the consumer and producer surplus. Nobody gets that little triangle. It's nobody's. That little triangle, the area of that little triangle is called deadweight loss. Deadweight loss, or DWL. Deadweight loss is the surplus that nobody, not the producers, not the consumers, not all of us collectively through the government, nobody, it's surplus that nobody gets after the tax is put into place. So it is the decrease, it's a measure of the decrease in the total surplus. One of the reasons that economists who are focused on efficiency do not like taxes, so when their goal is completely efficiency without anything else taken into account, one of the reasons that they do not like taxes is because the implementation of a tax results in a deadweight loss, where the deadweight loss is equal in dollar value to the area of that triangle that I shaded in yellow, deadweight loss. All right, that's it. I know that's a lot. Run through it a few times if you want, and the GSIs and I are happy to help you, and the tutors are happy to help you in office hours if you want to go through it again. You can play with it, play with the slopes of the supply curve, play with shifting demand instead of shifting supply, and you'll find that everything works out exactly the same. All right, thanks very much. Y'all have a great day. Here we go.